Ever wonder how these massive companies make those huge bet the farm decisions? The ones that make headlines? Well, it's not just a gut feeling. A lot of the time it boils down to one single incredibly powerful number. It's called WACC, the weighted average cost of capital. And once you get it, you'll see corporate strategy in a whole new light. Let's dive in.
Right. So this is the fundamental question, isn't it? Should we build that new factory? Should we go out and acquire that competitor? Or from a procurement standpoint, should we invest in a whole new technology platform for the entire company? The answers really hinge on understanding the cost of the money you need to make those dreams a reality. And that, right there, is where WACC enters the picture. Put simply, it's the blended average cost of every single dollar a company uses, whether it's from a bank loan or from its shareholders. I love this analogy. Think of it as a company's unique financial fingerprint. Just like a real fingerprint, no two are exactly alike. It tells you a story about the company's health, its risk, and its whole game plan. Now, to understand that fingerprint, you've got to look at its two core ridges, debt and equity. Every single company is constantly facing this dilemma. How much money should we borrow, and how much should we raise from investors, who then own a piece of the company? It's a critical, high-stakes balancing act. And this chart lays out the trade-offs perfectly. On one hand, you have debt, things like loans and bonds. It's usually cheaper, mainly because the interest you pay is tax-deductible. But, and this is a big but, it's risky. You have to make those payments no matter what. On the other hand, you've got equity, or stocks. It's more expensive because shareholders expect a higher return for taking a bigger risk. But it's also way more flexible. No mandatory payments, which gives you some breathing room. The secret sauce is finding that perfect mix. So, how do we actually combine that debt and equity into our final WACC number? Well, let's look at the recipe. This is how we actually calculate that financial fingerprint. And don't worry, it looks more intimidating than it really is, I promise. Okay, so here are our main ingredients. We've got E&D, the market value of equity and debt. That basically tells us the proportions of each. Then you've got R&E and RD, which is the cost of each, what shareholders expect to earn, and the interest the company pays on its loans. And finally, TC, the corporate tax rate. That's super important because of that tax break we just talked about. Let's make this real with a quick example. Imagine a company, we'll call it XYZ Brands. Let's say it's financed 80% by equity and 20% by debt. So, first, you take the equity slice, 80% of its financing, and multiply that by its 10% cost. That gives us 8%. Easy enough. Then you do the same for debt, but you factor in the tax savings. So that's 20% financing at a 5% cost, adjusted for a 25% tax rate, which comes out to a teeny tiny 0.75%. You add those two weighted costs together, and there you have it, 8.75%. That is XYZ Brands WACC. That one number represents the average cost for every dollar it has to run and grow its business. It's the baseline, the foundation for every major financial decision they will make. Okay, so we've got the number. But why does it matter so much? Why all the fuss? This is where WACC goes from being a boring calculation to a seriously powerful tool for making decisions, especially in procurement and financial management. It becomes the company's hurdle rate. I absolutely love this quote from our source material because it just nails the concept. Think of a track and field athlete. The lower the hurdle, the easier it is to jump over, right? In the world of business, WACC is that hurdle. And here is the golden rule. It's so simple, but so important. For any project to get the green light, whether it's launching a new product, buying another company, or a huge procurement deal for a new factory floor, its expected financial return must be higher than the company's WACC. If a project is going to return 10% and your WACC is 8.75%, you're creating value. Go for it. But if it's only going to return 7%, you're actually destroying value. It's that black and white. So you can see how this becomes a massive strategic game. Being able to lower your WACC is a huge competitive advantage. It literally means you can say yes to more opportunities. A project that might be a total loser for a high WACC company could be a fantastic, profitable investment for a low WACC competitor. It is a high-stakes strategic game.
The story of Tesla is a perfect real-world example. In its early, high-risk days, it had to rely on expensive equity financing, which gave it a pretty high WACC. But as it matured and started proving it could be profitable, it suddenly got access to much, much cheaper debt. By strategically changing its mix, Tesla lowered its WACC, giving it way more financial firepower to procure everything it needed for its massive global expansion.
And it's not just about the debt and equity mix. Companies have all sorts of other levers they can pull. Actively working to improve their credit rating makes that cheaper. Doing stock buybacks can signal confidence to the market, which can sometimes lower the cost of equity. It's this dynamic, constant process of fine-tuning that financial fingerprint.
But look, WACC isn't some static idea carved in stone. The world is always changing, and the things that determine the cost of capital are changing right along with it. So, what's next for this incredibly important metric?
One of the absolute biggest shifts is ESG. Investors are now looking at companies with strong environmental, social, and governance track records and seeing them as less risky in the long run. And what does lower risk mean? You guessed it, a potentially lower WACC. It's this fascinating new reality where doing good for the world can actually lower your cost of capital, making it good for business too.
And then, of course, there's technology. It's a classic double-edged sword. Investing a ton of money in something like AI can feel really risky up front. It might even bump your WACC up a bit. But if that investment pays off with huge efficiency gains down the road, it can dramatically lower your company's risk profile and its WACC in the long term. It's a strategic tightrope walk.
And really, that brings us to the ultimate takeaway here. WACC isn't just some boring number for the accountants. It's a living, breathing metric that reflects a company's risk, its health, its reputation, and its ambition. It's basically a compass pointing the way forward. So as we wrap this up, I'll leave you with this final thought. As our collective definition of value keeps expanding beyond just profits to include things like sustainability and innovation, what will the true cost of capital look like in the future? It's a question that strategists and investors are going to be wrestling with for years to come. Thanks for joining me to break down the power of WACC.